Hello everyone, I'm Nova Lui, RHB Bank Head of Investor Advisory. I'm very happy today that we have James Liu, a Senior Portfolio Manager at Schroders, Lead Manager of Global Gold Fund, and Co-Manager of the Commodities product. He joined Schroders in 2014 and is based in London. Thank you for joining us today, James.
My pleasure. Thank you for having me.
James, uh, global central bank policy are shifting, and many analysts predict a favorable environment for hard assets is forming. Given this macroeconomic backdrop, what is your specific high conviction outlook for gold's performance over the next 12 to 18 months?
Thanks. Gold has been in a strong upwards trend, a strong bull market for the past few years, starting really in 2022 and really accelerating in 2025. We think that trend, that upwards trend, is likely to continue over the next year to 2 years. In fact, we think that this is likely to be the strongest gold bull market that any of us will experience. We see two key drivers from a macro perspective for that. The first is geopolitical. We see ongoing tension in the geopolitical landscape, and in particular, we see an adversarial relationship between the US and China, which has not reached a point where we know what a new global status quo is going to look like. And we also think that as a consequence of that, the trend towards de-dollarization, which has been extremely evident in central bank reserves since the second quarter of 2022, when Russian foreign exchange reserves were frozen effectively. We think that trend is continuing. It's clear in the evidence or in the data that that is continuing. The second macro driver that we see is really fiscal, the fiscal reality that confronts politicians and policymakers in the US, in Europe, and in parts of Asia as well. And it's that fiscal reality, both high debt and high deficits, that is driving the so-called debasement trade, where investors are looking to diversify portfolios at the margin away from sovereign bond holdings, which they see as more risky as in the past, and they see paths in economies that look more like fiscal dominance type scenarios. So we think investor demand is likely to stay strong even as we get short-term periods of volatility.
Thanks. When it comes to the gold price, in the past 1 month, there has been a huge swing in the gold price from its recent peak close to 5,005 and the crash to close to 4,005. And as of when we speaks now, the gold price is range bound between 5,000 US dollar per ounce. So, based on the current market technical momentum and fundamental support, what would be the realistic price target do you project for gold by end of this year?
I think firstly, I would describe what happens in the silver markets as a crash. To me, what happened in the gold market was more an overspill. I think the gold market was impacted by what happened in the silver market, which to us was mainly a forced selling retail deleveraging event after we saw very significant retail speculative flows come into the silver market in both China and in the West. I think gold got caught up uh, in that selling. But, if you look at where gold prices are trading around that $5,000 per ounce mark, it's still significantly higher than the start of the year. And if you look at the midterm or the weekly charts, it's still very much in that uptrend pattern. So for us, we're clearly aware that volatility has picked up, and much of that has come from the silver market. But technically, we don't see anything that worries us too much in the gold charts. And we think that, sure, a consolidation phase in this range with elevated volatility is a possibility. But from a technical perspective, we think prices approaching 6 to 7K by the end of this year is actually entirely feasible.
Okay, seems like the mode or the overall market consensus view on gold is also bullish. Uh, if there is any unexpected shift in the real interest rate could disrupt the trend. What do you identify as the single most dangerous downside risk that could invalidate the current bull case for gold?
Sure, I think that's a very fair question. It's true, gold prices have moved quite a long way. Nothing is ever guaranteed. One point we would make quite strongly is we think the relationship between real interest rates, particularly US real interest rates, and gold prices broke down terminally in late 2022. I mean, in that period, we went from negative real interest rates of over 100 basis points to positive real interest rates of over 100 basis points. And yet, history would say that that should have been a bear market for gold. And yet, gold was actually extremely firm through that period. So, in terms of real interest rates themselves, we're not particularly worried about what happens there. But clearly, in any market, there are always downside risks. I think for me, I always go back to the two key macro drivers, fiscal and geopolitics. So debasement and de-dollarization. So I think anything that changes that narrative, anything that proves that actually we know what the outcome of those trends is likely to be, um, could be a downside risk. So I think one example would be if you see a very comprehensive deal between the US and China, which solves outstanding trade issues and puts the market's mind at rest when it comes to geopolitical tensions. I think that would be something that would change my view of what the gold market outlook was. Another driver of gold, obviously, has been central bank very clearly, is that we think the runway for that demand remains long. If you had a scenario where certain central banks actually re-reported or updated their central bank gold reserves, and those numbers were much higher than what is currently published, then that would also be something that would make us believe that forward-looking gold demand is not going to be as strong as we currently forecast. But to us, those are more tail risks. As a base case, we remain much more constructive than that.
James, we do have funds in Malaysia that invest into gold spot price and also gold miner. So mining stocks traditionally offer operating leverage, but comes with significant execution and geopolitical risk. Why should investor currently prefer allocating capital to mining equities rather than taking direct or lower risk exposure to spot gold prices?
I think that the gold equities um, offer different risk rewards. I agree with what you said. They come with additional risk to the gold price itself. And so I think an investor, but first of all, we're not of the view that it should be one or the other. We think an allocation to gold should be dynamic and should consider the different ways of taking exposure. But I would say, in particular, when we are in a period where the gold equities are clearly not reflecting the underlying gold price, or we are in a period where the gold equities are not reflecting a very, very strong profit margin environment, then I think there's a strong logic to holding a portion of a gold allocation in gold equities or gold producers. And that is the situation we are clearly in today. Just to give you one, I think one piece of evidence that backs that up is if you look at the cash flow per ounce that gold producers are generating, it is more than 3 times, more than 200% higher than the level that was generated in August, September 2020. Yet, if you look at the ratio between gold producer equity prices and gold spot prices, we're still below that level from 2020. So, whilst the equity prices have had a large move, they're nowhere near reflecting what is a completely transformed cash flow generating environment.
James, I want to go back to the earlier question when I asked about the price target, and I think the investor are also excited to know what would be the specific primary catalyst do you believe that will drive the next major leg in the higher gold prices?
Honestly, from our perspective, we think the next leg will be a very dovish Fed in the second half of this year. We are slightly confused that the market had a negative reaction to the nomination of Kevin Warsh as the next Federal Reserve chairman, and were worried that he would be a hawkish Federal Reserve chair. We certainly take the opposite view. We think it's very possible that this will be the most politicized Federal Reserve since the 1970s. And we expect the Federal Reserve or the new chair to attempt to cut rates into what is actually a strong economy in the US. So we think that that market realization that actually, whilst the incoming Fed chair might be able to talk about being hawkish, about reducing the balance sheet of the Fed, the reality is that the fiscal inheritance that he has, both in terms of deficit levels, debt to GDP levels, financing costs of that debt as a share of the budget deficit, the financialization of the US economy, i.e., the ratio of the US stock market to GDP, all of those things, as well as his own very close relationship with the Treasury Secretary, suggest to us that actually we're moving one step closer to a period of fiscal dominance or outright fiscal dominance. And actually, the idea of regime change at the Fed, which has been talked about a lot, is extremely unlikely. So we think a very dovish Fed is probably the most likely catalyst for the next leg higher.
You earlier did mention a bit about silver. So silver historically lacks gold but benefit from dual demand as both monetary and industrial asset. Do you currently see silver or platinum offering a better risk-adjusted return than gold over this specific time frame, like up to 12 months down the road?
We think that I think the outcomes in the silver market will always be more extreme than what we see in the gold market. It's a much smaller market. It's much more volatile. And as you say, it has a much clearer dual use case as an industrial metal, but then also as a monetary asset. So, I mean, our outlook from here is that we're still constructive on the overall environment for precious metals, but we certainly have more conviction and more confidence in the outlook for gold because we believe strongly that the breadth and the depth of monetary slash investment demand for gold is just that much broader than it is for the silver market. So I would say we have more confidence in the outlook for gold than we do silver. That doesn't mean that we think the outlook for silver is outright bearish from here, but certainly the fund through early January, when the silver market was going, I would say, into a parabolic move, we were already trimming some of the fund's silver exposure, which is now today around 8% of the fund from a high of closer to 13%.
And James, my last question is still on minor stock. Some investor is still potentially debating between going into gold spot or to gain some exposure in gold miner. So there's this question that inflation has persistently driven up energy and labor input costs for producers, squeezing profitability. How are mining companies effectively managing this margin compression, and does the current cost environment favor larger cap producer over junior explorers?
The miners today have the best margin environment that they have ever experienced. We have not seen margin compression in the gold sector since early 2024. In fact, what we have seen is very significant margin expansion that has not yet been fully reflected in the stocks themselves. The reason for that is very clear. We have a very strong market in underlying gold bullion, but we have not had very strong trends in the underlying cost base for the producers. So that includes labor costs, it includes consumable costs like steel, chemical reagents, explosives, and we have been basically in a range-bound market for fossil fuels. So I think the contrast, so essentially you're producing as a gold miner a monetary asset that is in a bull market, but your cost base is essentially labor and other commodity prices, where those costs have been much more constrained. That's complete different to, say, 2021, 2022, when we had lots of labor constraints because of the COVID crisis. And then in 2022, we had an outright crisis in the energy sector. So I think that, from here, we are clearly not any longer. We don't think we're in a bear market for oil anymore, like we were last year. We're more constructive on the oil outlook, but equally, we are not forecasting the type of energy crisis that hit in 2022. And what that means is, and equally on the labor side, we do not see the types of labor inflation that we saw in 2021 and 2022. And what that means is that we are still very bullish on the margin environment for the producers, i.e. the cash flow environment. In terms of the relative attractiveness of different subsectors, it really depends on valuation. So a large, diversified gold producer will always trade on a richer valuation than a small single asset gold producer anywhere. We think from here, one of the trends that we've positioned the portfolio to benefit from is that we think M&A in the sector, mergers and acquisitions, is likely to continue to be and accelerate as a very strong thematic. In particular, larger producers have been very, very disciplined in their capital spending and have not been chasing growth within their portfolios, which has been a positive for the sector and has led to much better shareholder returns than in past cycles. However, we think one of the consequences of that, as the industry starts to increase its long-term price forecasts and look ahead to its production profile in the 2030s, we think that there will be a large increase in mergers and acquisitions. And so from that perspective, that's one reason to expect the more junior end of the market to outperform. We also think that there is some tension in that M&A trend, in that we have both producers who are listed in, say, North America or Australia or London in some cases, looking at growth options, but we also have outbound Chinese interest in acquisitions. So we saw recently, for example, Zijin International, which listed in Hong Kong last year, acquiring or making a bid for Allied Gold, a producer that we held in the portfolio, a cash bid just about 2 weeks ago. So there's many, many drivers. It's not a simple answer, but we think the risk reward in the smaller end of the market remains very positive.
Thank you, James, for the detailed insight about gold and miners investment opportunity. Thank you for joining us today.
My pleasure. Thank you for having me.
Thank you for joining us today, everyone. I hope that the sharing from James will give you better informed investment decision. If you want to know about any other opportunity for investment for this quarter, do watch out for our quarterly fund discoveries idea. See you again in our next podcast series.